a good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me is Nikunj Dalmia as well as Avan Dubash. And for another positive bias continues in the market. We are seeing that the Nifty is just hovering around that 17,780 mark, but close to the highest point of the trading session. The big moves are being led by the banking names as well as the real estate packs. So both of those sectors are doing quite well. And of course, it's the penultimate day of expiry. So a bit of a volatility on account of that is pretty much factored in. Small cap index has surpassed the 100-day moving average and is sitting at a 2-month high level. So the broader market continues to outperform the Nifty, and even Nifty FMCG is holding up comfortably. In fact, it has hit an all-time high level. Today, of course, it's been led by Tata Consumer with the earnings coming in and the management talking to us about how they are looking at expanding their presence, their distribution network, and how FY24 is likely to be better year than FY23. So we are seeing that reaction, and of course, waiting for earnings for Bajaj Finance, Maruti Suzuki as well as HDFC Life. Maruti Suzuki should come out anytime now. The expectation is that perhaps they'll hit the mark of that 10% when it comes to margins. So watching out for that. And then earnings reaction so far, KPIT Tech deserves mention because it spiked as much as 6% post earnings. The FY24 guidance was quite strong, 27 to 30% growth in constant currency for FY24, and the margins are also expected to remain 19 to 20%. So quite a few stock-specific reactions is what we are seeing today, Avan.
Absolutely, and a lot of ET Now reactions as well, because we had some top voices on the channel today. For instance, as we said, Tata Consumer, the management betting on double-digit growth. AU Small, the management has also spoken to us saying that they expect the credit card business to turn profitable in the next year, but the stock clearly taking cognizance of the kind of earnings that it delivered and downgrades as well that have come in. And IndusInd Bank, the management said the NIMs will be in the range of about 4.3%, and they are looking at slower industry credit growth. But lots of newsmakers, Nikunj, we're losing count of that, but we're not losing count of the fact that for now, the index is continually making that attempt to surpass the 17,800 mark. Real estate, auto, those have been some of the sectors that are fueling that, but we're not really managing.
No, but we are not giving it back also. Think about it. The handover in the morning was not extremely pleasant one. Yeah. You had a cut in the Dow, you had a cut in the SGX, you had a cut in Asia, and by and large, you've done well. So frankly, if you ask me, the word underperformance now is getting substituted by the word outperformance. Now that's what you've seen for better part of 2022. Now is that outperformance which has eluded us, the outperformance which in a sense is the hallmark for the kind of economy which we represent and the earning promise we have, is that outperformance coming back? I really hope so, because now all the ducks are lining together. Markets have adjusted to what's happening to inflation on the global front. Markets have realized that the earnings drought is getting over. Banks are talking confident. They are sending on the right signals on the NPA front. IT's, Infosys there is a slowdown in the sector, but there is a company-specific issue with Infosys. So a lot of these factors which have haunted us, which have bothered us, which have dragged us, they're getting adjusted. And typically when that happens, that also tells you that markets are then getting ready for the next launch phase. And I think that's what we are. So I hope, I could be wrong, but my gut tells me that don't sell in the month of May and go away. Buy in the month of April, enjoy the month of May, and then we'll talk in the month of June.
Okay, that's Nikunj's advice. Don't sell in May and go away. Let's find out what our chartists think then. Kunal Bothra is with us. We've also got Naresh Mirani. Kunal, are you singing the same tune or flagging off the same line?
Yeah, I think so far so good, I would say, for the index, because the April series started off on an extremely negative note. I think we were almost 3 or 4 months consecutively flat to negative for the index, given the way the markets behaved in the last 4 months. So the start was a bit circumspect, but the markets are ending this, hopefully ending this April series with a lot more positivity. I would not say optimism as of now, because it's not yet getting reflected into the kind of positions being built up. So the only encouraging data which I spotted over the last 2 days for this expiry was that shorts are not being carried forward in terms of rollovers. I think that's an encouraging sign. Hopefully going into the month of May, we've seen very good sector distribution for the markets in the last couple of weeks, right from the likes of the real estate, pharma stocks, FMCG names making a comeback for themselves. And today again, yesterday and today, the banking stocks have made a decent comeback. So I think the mix of the market is also quite healthy. We can just expect that at the start of the May series, we can expect the same tone for the indices.
All right, let me also introduce Shibani Sarkar, who is with us on the show. But before we go to her, I want Naresh to get in your views as well on the markets as a whole. How are you looking into the fact while we have made those attempts to claw above the 17,800 mark, that hasn't been quite successful. But as Nikuj pointed out, on the downside as well, there has been no major move.
So over the last couple of sessions, there has been a little bit of a correction globally. We've not seen something similar here. That's an indication of strength. Now, when do we break 17,850? It could happen, say, in the next few sessions itself. There is a good possibility. So till the time the trend is up, you want to ride on to it, irrespective of whether it happens now or the next week. So for now, one could keep a trailing stop loss at 17,600 and ride on to this move. It gets into more momentum about 17,850. A similar swing high got taken out for Bank Nifty. So that tells you there is strength in one major part of the index. And the mid cap and the small cap indices are also back to that equivalent of 17,800 recent swing highs. So overall, bias and momentum is positive. Continue to ride on to the momentum, be more stock specific. Index may take a slow and steady move.
Steady move. Shibani, let's get in your take as well as to how you've read into some of the earnings that have come in so far. Is there anything that stands out, hits and misses?
Hi, good afternoon. So pretty early in the earnings season. So most of the earnings that have come out so far have been largely in the banking space, a few large banks and the IT sector. So within banks, of course, what really stands out is the fact that the overall earnings trajectory continues to be very, very strong. If you look at the expectation for this quarter and even going into next year, banking is likely to be a sector that will drive earnings growth. Loan growth has been strong, deposit momentum, at least in some of the names that have reported, and whatever is available publicly has been fairly strong as well and has seen signs of picking up. And in fact, the standout for me has been the margin performance for banks. Now, while Q4 will be a quarter where you see margins starting to peak out, but given the fact that exit margins are so high, it is very likely that margins going into FY24 may surprise positively vis-a-vis consensus estimates. So I think banking for us as a sector is a sector where we are generally positive on, and that positivity continues, and we believe that the earnings momentum should remain strong, at least going into FY24. Now, where IT is concerned, it's been a mixed bag. Obviously, going into the quarter, which is a seasonally weak quarter, expectations have been muted. However, the commentary from management seems to suggest that uncertainty continues at this point in time where decision-making cycle for IT budgets go. And focus of most of the clients have been towards cost takeout deals. Discretionary spending is under pressure, and therefore it is likely that at least for the near term, IT as a sector may see muted kind of a momentum where revenue is concerned, and margins have also bottomed out, but margin improvement is still not visible. So from a sectoral perspective, we continue to believe that domestic facing sectors are better placed. And within that, banking, auto, industrials, and cement, these are some of the few sectors that we are looking at.
Meanwhile, let's get in a view then on the charts. And Kunal, wanted your take on KPIT Tech. After having looked at the kind of numbers, the constant currency growth, and how the stock has reacted, what do the charts look like?
So again, we go back to the same theme that the mid-cap IT stocks are behaving a bit of a divergent way. It's not that all stocks from the mid-cap IT stocks are behaving in a very similar kind of a manner. So for example, Cyient, I remember, very clearly pre-result and post-result, the stock moved up significantly higher. You had, Coforge also, I think, which had done reasonably well. Most of the other IT names, I think L&T Technology Services, Infotech, Mindtree, those are the names which have actually gone to a correction. KPIT Tech, interestingly, is something which is now signaling a kind of a breakout for itself. So again, that move from the mid-cap IT names becomes a lot more divergent. KPIT Tech on current levels looks attractive for a possible retest of the previous highs. I think 925, 940 was the previous highs for the stock in the start of the month of April series. I think that level should be taken out hopefully in this leg of rally of the upside.
Oh, well, yes, and KPIT Tech had seen a bit of a badgering after that JP Morgan initiation saying that the stock doesn't deserve to trade at 50 times valuation given that growth is expected to slow down. But they are talking about a 27 to 30% growth in FY24. So maybe that's the reaction we are seeing. But others Okay, we also have numbers coming in from Maruti, wherein the first number is the profit figure at 2,620 crore, which is looking better than expectation because we were working with a number of around 2,500 crore as far as the bottom line is concerned. The key this time around, of course, was the margin figure that was expected to hit the mark of 10% again. So that is something that we'll track at this point of time. But the first figure, which is coming in with respect to the revenue, or rather with respect to the profitability, looks pretty okay. The PAT has come in at 2,623 crores. I'm looking out for more details, but I think in terms of the consolidated or rather standalone revenue, I think the top line is also around 30,820 thereabouts. Any other details, Avan?
As of now, we only have one headline number. The board has approved a dividend of 90 rupees per share. But let's just walk you through what the street was penciling in. As Anisha said, the key highlight was going to be margins, the fact that it would claw back to 10%. And this is after Q2 of FY21. So that is fairly critical. But for now, that number and the PAT figure of 23 crore rupees, that comes in pretty much in line to a little bit above what the street was penciling in. We'll also be watching out for what they deliver by way of the revenue growth, as ET Now poll had suggested about 32,529. Anisha, do you have more details on that revenue number? Yeah, okay. I think it's 32,048. So at that number, it's pretty much in line with street expectations. Naveen Kulkarni is with us from Axis Securities. Naveen, while we're waiting by for the margin number, we do have two headline numbers from Maruti, a 2623 crore PAT and a 32,048 crore rupee revenue number. What's your take?
Yeah, so the revenue number looks, I would say, that's slightly lower than what we were expecting. And the PAT number is largely in line. I don't see a significant difference. Important number, of course, will be the margin number for this quarter. So we were expecting around 10.5%. So if it's somewhere closer to that, I think Maruti numbers largely should be in line.
Numbers that street is talking about is closer to around 10.3, 10.4%. If that's the case, Naveen, would you give it a thumbs up?
I would say that these are in line numbers. See, this quarter which has gone by was not particularly great for Maruti, right? So January was good, March was not that great, right? So the volume numbers were already in. It is only a question of what kind of margins that they are going to report. So if it's in line, so I would say that more or less the numbers are not materially different. Stock performance from here will depend on what the management commentary is with regards to demand and how this year is likely to shape up.
And then, of course, we will be also watching out for commentary on whether or not there has been, some of those supply challenges have persisted in the quarter or whether or not they have been ironed out. Remember, we also have the higher volume, the fact that realizations as well are expected to be higher. And then we do know that the margins this time around would potentially be aided by the lower raw material costs and operating leverage. We will be interacting with the top brass as well of Maruti later in on ET Now. What is the outlook then on some of those challenges? If the management were to acknowledge that, demand is fizzling out or that we are seeing supply challenges, do you think that the street would take it fairly negatively, Naveen?
It's very likely that street will not like it, but the stock hasn't done much, right? So for the last couple of years, stock has been hovering in this range between 7,500 and on the top side it goes up to 9,000, and since 2017 highs, it has not even broken those highs, right? So from that perspective, stock has been an underperformer, right? And if these challenges continue to persist, I think the stock is more likely to be, will hover around these levels only. It will be more likely to have a sideways kind of, I would say that, performance over the next, let's say, 6 to 12 months if there is nothing materially improving or changing for Maruti.
It's like a largely line set of numbers. Naveen, we'll let you go on that note. We'll try and get more details. But in the meantime, Kunal, your take as far as the chart pattern is concerned for Maruti?
Well, again, I think the stock has disappointed, at least in terms of the recent chart patterns, because, I've seen this phenomena over the last many days that typically when a stock enters into a result with a correction, we've seen the stock going into a contra price action, which means possibly a rally. The stock of Maruti in the last 4 or 5 days corrected from 8,800. Yesterday, the closing was around the 8,450, 8,500 mark. But today, I think, seems like the stock has fallen from its day's high. So, which means that it's going into a corrective phase for itself. the near-term targets for the support for Maruti is around 8,200 mark. My only concern is that if the stock breaks below that 8,200 level, we could be looking at a major correction for the stock price. So, it's moving into a different direction altogether as compared to most of the other two-wheelers as well as four-wheeler stocks from the auto pack.
Okay, let's move on and talk about some other stocks as well. So Maruti definitely reacting negatively. The street was perhaps baking in a lot of surprise while the numbers have come in largely in line or a tad bit muted as far as the top line is concerned. Margins at around the 10.5% mark is what we have calculated for now, but we'll get you more details. In the meantime, Gujarat PSUs are the ones which are buzzing away in the trading session. Remember, there was a rejig when it happened with respect to the policy regarding bonus, dividend buyback, etc. And on account of that, names like GNFC, GSPL, etc. is also reacting positively. So all the Gujarat industry stocks are up anywhere between 5 to 10%. MCX is reacting negatively to the fact that CTO has resigned. Remember, the stock is already facing a lot of headwinds with respect to the delay in implementation of the new software. So 6% cut there. On the positive side, result reactions from Mahindra CIE is suggesting an uptick of 7% because the margins have expanded by around 200 basis points, while AU Small Finance Bank is looking at factoring in that NIM decline of 30 to 40 basis points for the coming year and hence a cut. Let's go across to my colleague Shrishti. Actually, if she's standing by and she has more details as far as Maruti earnings. Shrishti, what do you think is the big disappointment in the numbers?
A bit of a disappointment, I would not say, because all the headline numbers that we are seeing are almost in line. If we see the margin figure that has come in at 10.5%, and that's after FY21 that the company has clocked in a margins above that 10% mark, because do remember that in the last quarter, the company margins were actually around 9.8%. So there has been an improvement into the margin figure around 700 basis points out there. And not just that, if you look at the other headline numbers from the likes of revenue as well as the EBITDA figure, the company has performed a bit of in a positive manner, a bit of a surprise coming in on that front as well. If we talk about the revenue figure, that has actually come in at around 33,503 crores, and if we look at 3,350 crores at the EBITDA number, if we look at that's a jump of 179% on a YY basis. If we look at the profit figure, 2,624 crores is what the company has reported, and this is versus our expectation of 2,500 crores. So if we say, then the numbers are almost in line to what we were expecting, but given the fact that the stock has seen a bit of a jump up or a rally, there were some expectations. We are waiting to get the management commentary on how are they looking onto the margin outlook going ahead, because is this 10% margin sustainable given the recent upward movement we are seeing in the inflation, is something that we will be watching out for.
Thanks a lot for that. Now, what is on fire? Gujarat stand on PSUs. Now, whether it is GSFC, GMDC, GREC, just about everything which has got a prefix Gujarat, and it has to be a PSU, those stocks are massively up. Sumit's got some lovely data, and he's going to logically break it for our viewers that is this a rising tide phenomenon or this is a mini re-rating for this entire Gujarat-based PSUs.
Well, companies like GSFC, GNFC, Gujarat Gas, GSPL, Gujarat Alkalis, Gujarat Industries Power and GMDC. So these are the 7 companies that would be in focus because Gujarat state government has directed these companies that they'll have to give a dividend of at least 30% of their net profit or 5% of net worth, whichever is higher going forward. They'll have to do a buyback if their net worth is at least 2,000 crore rupees and they have a cash of more than 1,000 crore rupees in their books. They'll have to also issue a bonus shares if their reserve capital is more than 10 times their equity share capital, and they'll also have to go ahead and do a stock split if the current market price or the book value of the share price is more than 50 times its face value. Now, these are the directives given by the government to these companies. So, based on the data collected by our team, on the dividend payout, net worth, free reserves, their cash balance, what we are understanding at this moment is that GNFC is the only stock which will be eligible to conduct a buyback going forward. all companies in the list, all the 7 companies that I mentioned, are eligible to issue bonus shares going forward, while only GSPL and Gujarat Industries of the 7 companies cannot do a stock split at this moment, but all the other 5 companies can do a stock split. And when it comes to dividend payout, we are expecting at least the dividend payout to be double for GSFC, GNFC, GSPL, Gujarat Alkalis and Gujarat Gas, while for Gujarat Industries Power, we are expecting the dividend payout to increase by at least 800 basis points, while for GMDC, we are expecting the dividend payout to remain largely stable compared to what the company did in the last financial year.
Thanks very much, Samit, for really putting that data into perspective. And you can see at the bottom of your screens as well, that's the stock reaction playing out. Meantime, there's so many newsmakers, so let's also take cognizance of some of the other mid caps. Rallis India reported a net loss of about 69 crore rupees, and the stock as well, it seems to be reacting to those quarterly earnings. You have BST Industries from the get-go, that has been a weak link. The commodity inflation clearly seems to have dragged the profitability numbers, so that's another mover in trade. Tell you what, we'll slip into a very quick break. Be right back with lots more market talk.
With our technical experts and Shivani Sarkar from Kotak Mutual Funds to understand that what the way forward is for this market. Shivani, why do you think that the earnings cycle has bottomed out? Because banks are talking about slowdown, base effect has kicked in, IT is not going to do anything, metal numbers will not be there. A lot of sectors will either have a base effect or cyclicality in it, which means FY24 may not be great for some of these high performing sectors of FY23.
Yeah, absolutely. I think for the markets, earnings delivery is going to be extremely crucial. What we have been saying and what we believe is that, if you look at FY23, while there were some earnings downgrades, for Nifty as a whole, the earnings downgrades were limited to about 4 to 5%, and we will possibly still end up with double-digit earnings growth for this year. Now, for next year, for FY24, when you look at consensus estimates is today penciling in mid-teens earnings growth. However, what we believe is that FY24 will be a year where there will be wide dispersion in terms of earnings delivery, both at a sectoral level as well as at a stock level. So it is likely that while we go into FY24 with expectations of mid-teens earnings growth, the earnings delivery is going to be extremely, extremely crucial. And within that context, what we believe is that the domestic facing sectors are still better placed in terms of delivery of earnings. And therefore, when you look at FY24 in terms of contribution of earnings, sectors such as banks, industrials, auto, these stand out in terms of contribution. However, when you look at a broader market and a broader basket of stocks and not just Nifty, it is going to be extremely dispersed and stock specific in terms of earnings delivery. And therefore, FY24 itself will be a year where bottom-up stock picking and stock-specific names will possibly stand out. Wherever you see companies deliver on earnings, where earnings delivery has been healthy, those are the kind of names that we would want to focus on. But it's going to be extremely dispersed. That's what we believe.
Okay, so that's a take on how the market setup is and how crucial the earnings are. In fact, we spoke with a whole host of, corporate bigwigs today, talking about earnings as well as what the way forward is. Let's listen into the commentary coming in from the managements of Tata Consumer, AU Small Finance Bank, as well as IndusInd Bank.
This year will be a relatively easier year. Now, again, I'm keeping my fingers crossed there. And international, more importantly, we've taken aggressive pricing and structural costs. We've got strong internal numbers. We will continue to deliver double-digit growth and flow that down to the bottom line. And more importantly, we are looking at market share gains as well this year. I expect that tea costs will trend marginally lower if there are no unforeseen climatic things like droughts and floods, etc. That should aid margins.
The first foremost focus area for me is to build deposit, right? And that we are doing, very fairly well. Last year also we grown by 32%, right? So I think this year also, in spite of the higher rate cycle and, the lot more challenge there, but I hope that, we can grow around the range of 28-30% in deposits. The commercial banking space, which we started as a small finance bank, which is just coming up, right? That may grow in the range of 30-35%. So I think we have a well-diversified book. 92% book is secured. We deal at around 14-15% IRR. Historically, our asset quality has not deteriorated at all.
Our domains are coming from cyclical lows. So for example, the CV cycle or the microfinance cycle or the diamond, they've all contact businesses and were affected during COVID to a large extent. What we've seen in the last 12 months on the CV cycle, or we are not seeing, look at last 8 quarters, our margins have been very steady between 4.15 to 4.25, and that's been our guidance and we've been able to maintain. The book is such that our mix of the book gives us the margin. We have a very well balanced book between fixed and floating. So 51% of our book is fixed, 49. What happens is you see stability of margins, and that is what you're seeing in this bank, a very stable margin scenario between 4.15 to 4.25.
Okay, meantime, Shibani, while you walked us through some of the top sectors, which are the ones that you would avoid completely?
So, any of the global facing sectors where there is cyclicality. So currently we are underweight on metals as a sector. We are also somewhat cautious to neutral where IT is concerned. Here, of course, we have seen valuations correct, but what we believe is that the uncertainty in terms of the growth momentum, and as you know, revenue growth is one of the key drivers for IT as a sector. The uncertainty still continues and is possibly likely to continue at least for the next few quarters. So therefore, IT as a sector, we continue to remain somewhat cautious with focus on large cap names where valuations are more in your favor over mid cap IT. So these are some of the global cyclical sectors where we continue to remain somewhat cautious. And as we were discussing, the domestic facing sectors where growth and even the margin outlook seems to be better given the fact that commodity costs have come off. These are some of the sectors where we are positive.
We'll let you go on that note. Thank you so much for joining us. But it's time now to get the closing trades from our technical experts as well. Anuresh, you go first.
That would be a buy on GAIL India. The stock is very close to a new 52-week high and an all-time high, just a percentage away on a dividend-adjusted basis. The stock is trying to make that breakout move 110, 111. If it sustains 111, could see a quick 10% move over the next few sessions itself. So positive on this one for the short term.
Kunal, let's get in your closing call.
So that will be L&T stock, which we discussed, I think, a couple of days back as well, specifically around the 2,200 mark where the stock tested, the lows. So that's a stock which I would look to continue to hold on. I think it's now just get into a big breakout for itself. Hopefully, expecting another 50 to 70 points on the upside. So 2350 approximately could be a potential target range. So holding L&T.
Okay, that's the view coming in. Just want to quickly flag off Raymond. Remember that stock has been scaling up day after day. In fact, in the last 5 straight trading sessions as well, you've seen a pretty smart up move of double digits. The company has said that there's going to make a group-wide strategic corporate announcement tomorrow. It's not the number, so some sort of a corporate announcement at 3:30. So I think the street will closely watch out for that. Let's take a quick break. Be right back.
Okay. To making strategic announcement, we'll move on to market flashes after this. But for the moment, I think it's the Nifty which has spotted, and it has spotted again very smartly in the last 4-5 minutes of trade. Dipin Mehta, this market is suddenly showing signs of resilience. It is outperforming. It is ignoring bad news. It is reacting to good news.
Yeah, I think what's there to complain on, Nikunj?
No, I'm happy.
Yeah, you're right. It's a good observation that the market is showing very good resilience. And that's more to do with the fact that globally also markets are stabilized. And just enough of all this inflation and rising interest rates, I think investors have finally said that unless there is another accident or something, at least there is some end game for this rising inflation and therefore higher interest rates also. And many economists are now saying that the peak is over there. Maybe 1 or 2 more interest rate increases globally in India as well as abroad. And thereafter, you may have a long period of stable interest rates, and who knows, 6 to 12 months down the line, the interest rates may be cut. So I think the big cloud on the market of higher inflation and interest rates, that is gradually at least showing some signs of receding. I would say green shoots is the right word to describe that it is receding, but as we speak, that problem still remains. But then markets are forward-looking, and right now they are factoring that the worst is over as far as this interest rate inflation problem is concerned.
Numbers so divided, there used to be a time when one company goes, a large company indicates a trend that would apply for the entire sector, large cap, mid cap or small cap. That is not true. There is a big divergence in TCS, HCL Tech and Infosys. There is a big divergence in Mastech, KPIT and what we're hearing from other companies, Cyient.
Yeah, absolutely. I have never seen this kind of selectivity in performance in IT, and I've been tracking it right from 1998. There was a period when large cap used to do exceptionally well as compared to mid cap, and you always wondered that the gap between Infosys and the mid cap companies was only increasing and not decreasing. But last 2-3 years, we have seen mid cap grow at a much faster pace than the large cap, and more so within the large caps also there is divergence in their kind of growth rate. But that's really the sign of the maturity of the industry. And from a mid-cap software company's perspective, they have finally, come and recognized their strengths. They are focusing on specific niches. They are focusing on specific talent and what kind of jobs and projects they can do. And the clientele also is understanding the importance of working with such niche players and extract maximum value out of them. So it's a maturity of the entire industry. It's a maturity of the investors who are investing in these companies also. They are discerning the smaller differences which exist, where the managements are aggressive in terms of getting good quality projects, which verticals the management is focusing on, where there's the least chance of a cut in tech spending, where is it that disruption is taking place, like auto industry, where there is no way that the client can cut any tech spending. In fact, they are too dependent on the vendors to take them to the next level. So it's, I think, a very few important trends and sub-trends are taking place, because of which we are seeing this divergence in performance and we are seeing this divergence in the stock price. And that means that the job of the software analyst has only increased manifold, because now you really have to find the gems and avoid the companies where you feel 2-3 years their growth may slow down or there may be stagnation. So it's, I think, more hard work for us, and I think more selective strategy on the part of the investor as well.
Okay, but for now, the market is holding on quite steady. In fact, at the highest point of the trading session as we speak. Let's talk about some of the beleaguered names as well, Dipan. The likes of Ipca Laboratories as well as Crompton Consumer have been getting the drubbing from the last couple of trading sessions. And then today, MCX2 is down about 6% on account of that CTO change. Any name that you track from this pack? Anything that you would want to recommend?
Well, I track all of them. So MCX, I think, these days exchanges are more like technology companies, and loss of a key personnel certainly does tend to impact. But it's now a reformed organization. It's got solid backers, and they will definitely attract talent. And MCX certainly, I think, is in a very sweet spot again, because they are the largest exchange on which gold is traded, and gold prices have been consistently going up. And also in MCX, they are seeing very good growth in their options trading as well, which earlier was eating up into the transaction fees on the futures. But now that potential to scale up those volumes is phenomenal. And we are actually seeing in our broking community that many of the prop traders, the large broking houses, they are trying to focus on using the capital to trade in options once the equity markets are closed. So I'm very positive on MCX, no doubt about that. And this may be a minor setback, but they will certainly fill the position. Crompton Greaves also, I think, I would say it's a bit of an overreaction. One CEO cannot make so much of a difference. And also the fact that maybe their performance may get under a bit of a stress because of the acquisition of Butterfly Gandhidham, but that's a good acquisition in the long term for them. And I would think that the company should report decent numbers this quarter and next as well, because of the kind of seasonal impact. And it's been a really warm summer, and they are market leaders as far as fans are concerned. And this acquisition gives them more diversity in terms of their product profile. So I'm very positive on that company as well. And I don't forget, the third one is which one you asked me about was?
Ipca and MCX were the three stocks we wanted to discuss.
Ipca, I think that's a bit of a mystery why they want to go in for a pure generics exporter. when in fact the entire generics market is under so much of stress and there is so much of competitive intensity. The way most pharma companies are going is they are focusing on the domestic market, and if cars doing the opposite, maybe they know something which we do not know, or maybe they just want to get into the US generics market anyhow, and they are buying these capacities so that they can get that line of business going. But I think it's not such a great strategy from my understanding, because the real value is in the brands and the kind of growth which we are seeing in the domestic market, where healthcare spending is on a secular upturn.
Okay, and while we're awaiting a lot of numbers today, later on, tomorrow as well, it's pretty busy on the earnings calendar. Wipro, Axis Bank, Bajaj Finserv, HUL and Tech Mahindra, those are the Nifty 50 companies that will be declaring their quarterly earnings. Dipan, if I were to handpick just HUL, we're expecting a 5% volume growth. What's your sense as to how we are likely to, see the margins shape up for the company? Do you think that it'll continue to remain flat, largely due to the hike in the royalty charges? What's the outlook on HUL?
See, it's a complex company, but if Nestle's results are anything to go by, then I would say that HUL also could have a positive upside. And if you look at Nestle's result, because they are somewhat similar line of business, they saw decent volume growth, and the fact that whatever price increases they have taken, that has started to flow to the bottom line, and the average realizations have also gone up. And on the whole, I think the company delivered a very good set of numbers, and something similar can be expected in HUL. We have seen the revival of the rural market last couple of months or so that also will benefit HUL. And maybe you may have operating profit margins looking up, and some amount of volume growth higher than what the street is expecting also is what we are factoring in just now. So very positive, at least on this quarter, for HUL's numbers, looking at what has come in Nestle. But the valuations, we all know what they are, and many of the categories that HUL operates in are at maturity level, like soap, detergent, toothpaste. There's only so much growth that they can squeeze out of it. So from that point of view, I'm not such a great fan of HUL on a longer term, like a 3 to 5 year basis, where that can deliver good returns also. But there may be a trading opportunity for next few days or weeks in HUL on the expectation of a good number.
All right, now what do we have? We've got some Gujarat-based stocks which are doing exceedingly well. Nuresh, when you see a big breakout like this in a GN, in Gujarat Alkali, GMDC, GSFC, what should a trader do? Jump and rise to the occasion and identify them as the momentum names now?
So if you have not jumped in right at the open at 20% higher, a risk reward is not interesting. Also, the delivery volumes would be low because today it's a news event. So I would wait for a fade off in names like GMDC and GSFC. Basically, say the stock has gone up 20%, wait for a 5-7% decline and then maybe look at it. So I would expect some bit of a fade off going forward, and that is the time you want to get in. It's been too fast of a move in a single day. So wait for a little bit of a dip and then maybe try. Otherwise, the risk rewards are not great.
100 points. We are up 100 points on the Nifty. And Kunal, 17,800, 17,850. These are the congestion zones. Looks like we're going to just go zoom past that now.
And I think the timing of this breakout is also very interesting, because monthly expiry, the 17,800 mark, for example, has been a huge hub for call writers. Now, when you're heading towards the monthly expiry, which is tomorrow, it's going to create a lot of pressure for the option writers to hold on to their position. So I think the last half an hour move, the moment the index scaled past about the 17,800 mark, all I could see in terms of data was a very sharp set of unwinding from the option traders. Now, I'm not sure whether this would probably have a resultant effect tomorrow, but if we happen to see maybe a 20 point, 30 point gap up also tomorrow, and assumingly, say if we cross back, say 17,850 on the spot levels, it's going to create a huge effect on the short covering for option writers tomorrow morning. So I think it's and that could probably have a ripple effect into the expiry tomorrow. So I think it's going to be an action-packed day from looking at the data and the last half an hour of recovery. If we hold past about 17,850 mark, say for the next, say by tomorrow first half an hour, first 1 hour, then I think it could be a very strong pickup of market action tomorrow.
Then we are up 1,000 points on the Nifty. Now mathematically that's not much, but a 1,000-point rally in the month of April and late March is a meaningful one. Do you think we've seen the worst of the market level in terms of evaluation for this year?
No, because the more important thing is that we were saved the blushes. I think the lows which we saw when the market traded before the 200 below the 200 moving average, and technical analysts always tell me that when the golden cross, the opposite of that, when that takes place, that's when the 50-day moving average crosses the 200 on the lower side, that's really a danger sign. So the death cross. So we really avoided a lot of the huge downside by rallying the way we have over the past 1 month or so. And I think that if this kind of a trend continues, then this entire pattern of lower tops, lower bottoms gets converted to higher tops, higher bottoms, and that I think is something which is great. We can build upon it, and we can then definitely say that we have a very tangible and solid bottom in place, and that will bring a lot of confidence also back into the investors, because there's no denying the fact that it's great to say that it's best to buy when the markets are down and when there's blood on the street. But how many investors, even professional ones, are really able to follow that advice? We typically like to buy when the markets are rallying and rising, and such markets followed by such good, corporate news coming in the form of better than expected street numbers for most of the companies and large industry groups. I mean, banking doing as well as it has automobiles also doing as well as they do, and then we have this entire infrastructure space which is also going to deliver good results. And at least the negative numbers coming in from the tech sector, the software, are restricted to a few companies. So all of this gives me the kind of impression that maybe the market can certainly scale to higher levels. There could be corrections on the way, but I'm getting more optimistic on the longer term trends than I was maybe a few weeks ago.
Like RVNL, why has it gone up? 20% yesterday, it was up. If I look at the intraday graph, almost at 114 has become 103. The volumes today in RVNL are more than, and it's 100 rupee stock, it's not a small 2 rupee stock. The volumes in RVNL today are more than the combined volume of Yes Bank, Vodafone and Suzlon. Yes, the volumes on National Stock Exchange and RVNL today are more than the combined volume of Vodafone, Suzlon and Yes Bank. Now let me tell you the value. I mean, ultimately it's the value transaction which matters. In the cash market today, RVNL has traded more than ICICI Bank, HDFC, Axis Bank, SBI, Reliance. Hello, Dipin Mehta. Isn't that a fascinating data? And I'm reading it live.
Yeah, but what is surprising about it is there is going to be a speculative activity, then all the traders are going to zoom in. And whatever trading volumes you are seeing is not by investors who want to buy RVNL just purely based on fundamentals. They are chasing momentum, and that's taking the stock price up. And Nikunj, for a fact, there are so many algorithms also into play over here, intraday algorithms with servers at NSE data center. And the minute they see this kind of upswing, all the traders and all the strategies start to focus on such stocks, and then we have the kind of excellent move which you are seeing just now. And why just RVNL? You will see in the Gujarat-based companies, the Gujarat PSUs also, something similar when you start to analyze their volumes. It's not surprising, but on the whole, this entire railway story is good. RVNL is available at attractive valuation. The kind of resistance and skepticism which investors had over PSUs is gradually decreasing. In fact, there was a time when to have a PSU stock, state or central PSU stock in your portfolio was a bit embarrassing. But now I think more and more investors want to get more of these PSUs in their portfolio. They are cheap, they give high dividend yield, and on the whole, I think the government policies are certainly beneficial to them, and they're clearly able to get the maximum out of their monopolistic or near monopolistic position in the sectors they're operating in. The PSU tag is definitely a benefit now in gaining more and more revenues and profits for these companies. So I'm not surprised with the kind of move which we are seeing in RVNL just now. It is just about playing catch up after many years of underperformance.
Question, Dipin, is that you see a speculative frenzy. Frenzy is the word. I'm not getting into the right, wrong, big picture, the railway, capex cycle. But when you see such a frenzy, isn't that the time investors should say that it's time for them to take it easy?
No, Nikunj, we are far away from frenzy. This is a frenzy in one or two stocks here or there.
No, stocks. I'm talking about railway stocks, capex stocks. I mean, I'm talking about, is there a frenzy in some of these railways, defense, capex, industrial, cyclicals?
No. I categorically no. There is no frenzy. See, this is the market. You will have days or weeks when certain stocks are in limelight and you get 25-30% type of appreciation. and then for months on end, you will see sideways to declining trend in them. There is no frenzy. The delivery volumes are on the higher side. It's not that the valuations are out of whack over here. It's also the fact that we are seeing heavy institutional volume also playing out on our stock market just now. So it is not, and the leverage in the system is extremely low. So there is no frenzy. The cats and dogs have not started to move up as yet. I mean, we are long way from there. And I think it is just, after many months of sideways to declining trend, we are seeing sparks happening in the market. And let's not overthink too much over here that are we going too much on the bullish or on the other side. It's just that the focus and the strategy has to be to find the next RVNL or the next Gujarat-based PSU, or where the action is going to be in future. And we are in the earnings season. It's the time when there is highest degree of volatility, stock-specific volatility, and there are good trading opportunities as well. Some number comes up which is exceptionally good, you may see a rally in those stocks, and see what happens to the banking stocks. I think all have delivered numbers better than what Street was expecting, and we have seen decent rally over here. And really, according to me, the real sector to watch where you'll see maximum positive surprises would be the capital goods sector, companies ranging from Larsen & Toubro to NCC, ITD cementation, and then you have the engineering companies, ABB, Siemens, Thermax. I think these numbers are going to be quite eye-opener according to me, and you could see perhaps strong rallies over there. Maybe some expectations have got built in, but these are all companies coming out from a low base effect with multi-year, depressing trends within the industry, and now they are coming through with surge in order book positions. Margins also will be expanding because of operating leverages, stable raw material prices, as also the fact that a lot of the orders are at high margins. So a lot of positive things happening for two large industry groups. One is the capital goods, second is the bank, and of course I think autos also are doing great. Bajaj Auto numbers I thought were pretty decent considering the kind of stress they are facing in the export market. So I would say that at this point of time, there are many investment teams working out for investors rather than not working out. And what's not working out is broadly software, where you need to be a bit careful what you're investing in. But by and large, I think most sectors, most industries, the larger organized players are doing pretty well, and they should report decent numbers.
Sorry to interject, we're just towards the closing, Dipan, but I just wanted to flag out a few more stocks before we take the closing trades. We have Avas Financiers down about 5%. Remember, the MD had sold some stake and the Catalyst watch was removed from Citi, so 6%, 5% cut coming in there. Nykaa is one stock which has been languishing at all-time low levels, and then you have a lot of other names like VST Industries, etc., which are reacting to earnings. But let's take the BDSC ideas quickly. Kunal, quickly, the BDSC trade on your radar?
So I'll suggest a couple of buy calls. The first one, which I'm actually suggesting is a buy on, Titan. That stock looks attractive at 26.30 mark. So it's of 27.50, stop loss at 25.75. And DLF is one stock which looks extremely attractive on the positional charts. Targets of 440 and stop loss at 400.
Nuresh, quickly, your picks.
So that would be a buy on GAIL India with a stop loss at 108.5 and a target price of 114. And another buy on L&T with a stop loss at 22.55 and a target price of 23.20.
All right, Dipan, let you go on that note. Thanks so much for taking time out and joining in. Let's start by wrapping up today's market action then. And Wednesday, we go home with a print of 17,800, a day ahead of expiry, wrapping up the month as well, gone by of April almost at 1164 in terms of the advances in favor of that. And for the Sensex as well, 60,300. So it's certainly an attempt to pull back after all the give and take. And what's aided that? A lot of sectors, realty, FMCG, PSU banks, auto, even the Nifty bank and infra have packed in a punch along with IT. Take you through the winners in trade today. It's an extensive list of that. Power Grid, Tata Consumer, Nestle, SBI Life, L&T above the 200 DMA, Eicher Motors, SBI looking good, Axis Bank, HDFC group of stocks entirely. So all of those have really been smart movers in trade today. Hindalco loses out, Bajaj Finserv as well down 1%, Adani Ports, and Reliance Industries hasn't quite contributed on the upside. There's a plethora of newsmakers Maruti came out with numbers. It was pretty healthy, pretty much in line with what the street as well was anticipating in terms of margins. The stock goes home absolutely flat. KPIT Tech came out with its numbers. They're seeing cross-currency revenue growth guidance in the range of 27 to 30% and completely cheered by the street. Poonawalla FinCorp, another result reaction. And you also have MCX. That stock came under pressure as the Chief Technological Officer resigns. A huge booster for the Gujarat-based PSUs. Remember, the state government has announced new policies for the minimum levels of dividend substitution and shares, and that has sent all those stocks on a high in trade. Ipca Labs, just a quick check-in on that counter as well, as they're eyeing stake in Unichem Labs. And remember, the management as well went ahead and said that they're targeting to achieve a 300 crore EBITDA for Unichem in the next 2 years. Indian Hotels on Morgan Stanley's radar. It's an overweight rating. VST Industries, Rallis India, Mahindra CIE all reacting to numbers. And then, of course, we had a slew of big voices on the channel. A quick look at the broader markets then, and MMTC, Mahindra CIE, Lemon Tree Hotels, KPIT Tech along with IBREL are some of the interesting movers. Come tomorrow as well, we'll be watching out for a lot of Nifty numbers: Wipro, Axis Bank, Bajaj Finserv, HUL and Tech Mahindra. All right, with that, we'll wrap it up on this leg of the show. Thanks so much.